Hello and welcome to the Credit Compass, your guide to navigating the European credit markets. We break down the biggest moves in credit, uncover the macro trends reshaping the landscape, and explore the fixed income strategies defining the financial future of Europe and the UK. Today, we're picking up the first tremors from newly announced US trade tariffs and exploring what they could mean for credit markets across Europe and the UK. We'll dig into the latest Purchasing Managers Index data, touch briefly on eurozone GDP, and wrap up with the credit investors' homage to the Oracle of Omaha. Let's dive in. The latest Purchasing Managers Index reports provide a useful snapshot of economic sentiment, and crucially, they were collected after the U.S. administration announced new tariffs on April 2nd. That timing gives us an early glimpse into how companies are responding to rising trade uncertainty. Let's start with Europe as a whole. The overall PMI reading for April came in at 50.4, marking the fourth straight month above the expansion threshold of 50, but a slight dip from March's 50.9. While this suggests modest continued growth, the details reveal more complexity. Manufacturing was the standout, posting its strongest activity since 2022. In contrast, services activity stagnated after 4 months of mild expansion. The impact of tariffs is perhaps most visible in new order intakes, which have been declining over the past year and fell at a faster pace in April. There were notable regional dynamics. Italy posted the fastest increase in activity in 11 months, reclaiming momentum. Ireland continued to see robust expansion. Spain remained positive, though at a slightly slower pace. And Germany surprised on the upside, bringing in a flat 50.1, an upward revision that brought it out of contraction and ahead of consensus expectations. Zooming in on manufacturing, most economies outperformed forecasts. Germany and France both saw upward revisions from their preliminary readings, while Italy came in meaningfully stronger. Part of this could be attributed to front-loading, companies accelerating orders ahead of the tariff implementation. If so, we might see that trend continue into May and June as the 90-day pause winds down before July. Preliminary GDP released last week added another piece to the puzzle. Euro area output grew 0.4% quarter-on-quarter, double consensus expectations. The upside surprise came primarily from solid domestic demand. Services continued to drive growth, particularly in France and Germany, while construction and investment lifted activity in Spain and Italy. Manufacturing, long in a slump, showed signs of life again, with Spain and Italy recording meaningful gains. Ireland stood out with a 3.2% surge, largely due to multinational corporate activity. Spain grew by 0.6% and Italy by 0.3%. France and Germany lagged with just 0.1% and 0.2% respectively, but notably migrating into positive territory. Hungary was the only EU country to contract. The key takeaway from all of this is growth across the bloc is increasingly powered by internal resilience, not external trade, at least for the first quarter. Turning to the UK, the picture dims slightly. The PMI for services, which represent roughly 75% of the UK economy, contracted in April for the first time since October 2023, falling to 49 from 52.5 in March. Export orders declined at their fastest rate since 2021. Trade uncertainty tied to US tariffs likely played a role in curbing demand. Markets are now looking to the Bank of England's monetary policy meeting this week, where a rate cut is widely expected to help counter the slowdown. There is one recent bright spot, and that is that the UK and India agreed to a new trade deal that lowers 90% of tariff lines for British exports and reduces tariffs on 99% of Indian goods heading to the UK. In a post-Brexit environment where new trade deals have been few and far between, this marks a notable step forward. It also signals a broader trend. As the U.S. leans into protectionism, others are looking outward for trade liberalization. Now, that point about trade openness was echoed in Omaha at the Berkshire Hathaway annual meeting. Warren Buffett reminded us that lower trade barriers benefit everyone. And as he gradually steps back from Berkshire's helm, it is worth reflecting on his legacy, especially through the lens of a credit investor. Buffett didn't just buy equities, he underwrote the American economy with the patience of a seasoned lender and the foresight of a risk officer thinking beyond the next quarterly result and instead looking years ahead. He indicated that his Japanese trades have many, many years to run. He taught us that float isn't just idle insurance capital, it's low-cost, enduring liquidity, a quiet engine powering disciplined long-term investment. Much like a credit investor, Buffett believed that cash is king. In a market chasing yield and piling on leverage, he stayed grounded. His legacy? Not just equity outperformance, but a framework for thinking about risk, return, and responsibility. One that credit professionals would do well to keep in mind. As Berkshire turns the page, his principles will still echo through underwriting memos asking, what would Buffett do? He's shown us how to call out market froth. Ahead of this year's volatility, Berkshire built a large cash position, signaling concern about high equity valuations. At the AGM, he downplayed current conditions, saying, "This isn't a very dramatic bear market." We gently disagree with one part of this statement. It certainly has been dramatic this year, and likely with more drama to come. So where does this leave us going forwards? I think what we have seen so far has been a hesitant rally with many still skeptical on what to expect. Markets are holding their breath as we approach the end of the U.S. tariff pause in early July. Meanwhile, everyone is watching for early signs of the impact to businesses as we move through this uncertain period. As we highlighted, Europe is weathering things relatively well, although it is still early days. That's all for this edition of The Credit Compass. If you found this episode useful, be sure to like, subscribe, and share it with colleagues and friends. And please reach out if you have any questions. For more on credit ratings and our in-depth financial research, visit us at KBRA.com. Until next time, stay curious, stay informed, and stay resilient. Let The Credit Compass help guide your way.